Sanjeev, fantastic to have you back and thank you for joining us. Well, the moot point clearly is that earnings season has started. Infosys yesterday certainly, set the cat amongst the pigeon when they said that they would like to reduce their dollar guidance.
Well, the results were good, clearly, 6% QOQ. Nobody was expecting that kind of blowout quarter. And so let's say, of course, the guidance wasn't that great for the second half. Even though the company is maintaining, full year guidance in constant currency terms and dollar numbers look weaker. And on top of that, you had the news of CFO resigning, which wasn't, I guess, well received by the market. So even though the numbers were very good, you had some of these other factors which probably resulted in the stock actually coming off despite the very strong numbers.
Sanjeev, good morning, Neeraj here. How does that keep the mood for IT at large? Because while we are awaiting TCS today, HCL has already sounded off a warning. Wipro, in the last quarter earnings call, did mention that this quarter will be ho-hum, so to say. Infi, the guidance hasn't been the best. If TCS doesn't surprise either on the quarter or on the guidance, could there be a bit of a corrective action in the IT space at large?
It's possible. You already have seen that to some extent. If you look at HCL Tech, of course, you had now 2-3 quarters of weak guidance and also weak numbers. So the stock's already come off quite dramatically before the results. Wipro, anyway, people not expecting great numbers from that company. So if TCS delivers 4% plus QOQ growth as far as constant currency numbers are concerned, I think it would be received fine. But if it's anything weaker than that, then clearly people will start extrapolating that to much weaker growth for the IT companies going forward. Obviously, a lot of concerns have started to build in terms of the pricing dynamics which have started to emerge in the sector, and whether the companies are well prepared to participate in the new areas which have opened up. So, all those things will be reopened if the numbers for TCS miss today.
So what is the broad expectation then, Sanjeev, from the earnings season? Any dark horse that you expect could actually rise out, or do you think at large Q2 will be a very, very tempered earnings season?
It's very early to say, what dark horses will emerge. So, of course, we have built in our numbers based on whatever trends we saw in the last quarter. So, as of now, for the BSE 30 as a whole, we are looking at about 3% decline. Let's see, what comes out. The clear sector where you have to watch out for any disappointment is the banking sector. The on and off, there are murmurs of NPL numbers, rising well above, whatever the banks have guided. So, let's wait and see, because it's a very large sector, and that can change the earning numbers quite dramatically. So far we have built in reasonably strong numbers for both the private as also the public sector companies. But any disappointment on the NPL numbers over there will not be well received by the market.
Okay, Sanjeev, what about the commodity space at large? There is a serious bounce that has come in already into almost all of these. Hindalco, of course, has a different story for the reason because of which it is down 8.5% today. Don't know how much will get proved, don't know how much will come out. But I think Hindalco has a specific problem. Aside of that, almost everything is bouncing up. Is the bounce overdone, and is this just a dead cat bounce which will get sold into?
In some of the cases, maybe it is justified. For example, if you look at the oil sector, you're expecting a tightening more in the medium term. Maybe the market has started to factor that. If you look at the supply dynamic for oil next year, the IE is projecting a decline of about 0.6 million barrels per day for non-OPEC supply, whereas demand is going to be still pretty strong at about million barrels per day. So you're looking at significant tightening on oil supply-demand balance next year. If you look at zinc, again, the fundamentals look reasonably strong. You have a number of closures which already been announced. On top of that, Glencore announced closures of about 500,000 tons per annum recently. So all that put together, you're looking at about 1 million tons being taken out of the zinc market. And that's a pretty big number on a 13.5 million ton of global demand. That's a reasonably large amount of supply being taken out. As far as aluminum and steel are concerned, I'm not very sure about the improvement in prices that you have seen of late. A lot of it could be just to do with the fact that, as far as the stocks are concerned, people are taking a more, benign view of US interest rates going forward and taking on a slightly more aggressive risk positions for now. So maybe that explains the big bounce which you have seen in the commodity stocks. Some of it is justified, some of it is just sentiment, I would think.
We've seen a terrible September and a terrible August. and markets have stabilized by and large in the month of October. So do you think the storm has come and gone? The worst of the price action is behind us?
Probably, a lot of this basically reflects the fact that investors are taking a slightly more positive view on the US Fed rate increase. Now people are assuming that it would be probably in the first quarter of next year. Clearly October is off the table as of now. Maybe December also looks a low probability event, and maybe that is what excited, some amount of risk taking as far as investors are concerned. So if you look at emerging markets, generally I've seen a fair amount of inflows in the month of October, compared to pretty significant outflows that you saw in the months of August and September. And India is no different. We have seen a pretty significant amount of inflows both on the cash side as also the F&O side as far as the month of October is concerned. So, if you continue to see, maybe weak economic data coming out of the US as far as, labor data is concerned, maybe that could, probably result in this rally continuing for some more time. But I would be a bit careful because, valuations are no longer that supportive as far as the market is concerned. Late August, early September, a lot of stocks were trading, at well below their fair valuations. Now, I think based on the bounce that you have seen in some of the oil and gas stock, metal names, even the financials, I think that gap is no longer as favorable as what was earlier. The risk reward balance is no longer as great as what it was in the months of, let's say, August and September.
The macro cues from India's side, the last 4 or 5 reported cues that have come in, be it the IP CPI that have come out overnight or a couple of other cues that have come out in the last 1 or 2 months, have not been too bad. Add to that the 50 bips cut by the RBI as well. So on that front, things seem to be a bit okay.
No question about it. So if you see even over the last 12, 15 months, you have seen a dramatic improvement as far as the macroeconomic parameters are concerned. So whether it is current account deficit, the last reading was for the June quarter, that was 1.2 percentage points of GDP. So that's pretty remarkable compared to 4.7, 4.8% that you saw in the fiscal 2012 or 13 years. Look at inflation, that is clearly coming down. So even though the last data point in CPI did suggest an uptick, that was more or less than expected lines. And I think we are still within the trajectory projected by the RBI for the rest of the year. So I think we are fairly comfortable on the inflation part. Lastly, on the fiscal part, again, we have seen a remarkable improvement on the fiscal part. And government is talking about 3.9% gross fiscal deficit GDP as far as the central budget is concerned. I think looking at the way excise revenues are growing this year, thanks to, the increase in excise duty on diesel and gasoline, I think that number should be easily achieved despite much high expenditure on the capital expenditure side. So the macroeconomic parameters look good. The missing point is still growth. So all the improvement that we have seen in the macro so far, in a way, is not transmitting into micro. In a way, we are still not seeing the private sector being confident about to invest. So let's see, how quickly the growth equation comes back. Anyway, the numbers are not bad as far as growth is concerned, but the missing element is still the private sector investment. And hopefully, as you see more of rate cuts, some stabilization of macroeconomic parameters, hopefully NPL numbers, not getting too much out of control from where we are, you could probably see private sector investment also starting to trickle in.
So, Sanjeev, over the weekend, I met an old-timer of Reliance Industries who is now of the view that after 7 years of underperformance, Reliance is looking good for a big trading rally. Bulk of the capex is over. Reliance Jio launch is around the corner. Would you agree with this very basic assessment?
Well, see, on a non-Jio basis, if you just look at the core petrochemicals and refining business, the company is doing quite well, even though refining margins have come off a little bit in the last couple of quarters. They are at reasonably healthy levels, and so are petrochemical margins. And if you look at our numbers, as and when Reliance completes the 2 ongoing projects on the petrochemical side, as also on the coal gasification projects, we are looking at somewhere about 95 rupees EPS annualized whenever these 2 projects are complete. Just for treasury shares, you're looking at somewhere about 105 rupees. So that means this company, just on the core petrochemicals and refining business, should be somewhere about 1,050 kind of a number, which is a reasonable upside, 15% from where we are. As far as telecom is concerned, there is a very divided camp over here. Some people, think Reliance can maybe extract some value from here, but the bulk of the view is that it will be a loss-making proposition for a very long time. It will destroy value as far as the current investment is concerned, and the stock price is in a way reflecting that. If you look at the fair value of the petrochem refining business, that's probably higher than where the stock is currently. So in a way, the market is already, subtracting some value or maybe applying a negative value for the telecom business. So let's see, how the telecom launch goes. If it is successful, you could probably see a big re-rating in the stock price. If it's a disappointment, then maybe the stock comes off a little bit because, as I said, a lot of the expectations on the telecom side is already quite low.
From a market mood perspective, how crucial would be the Bihar elections and, more importantly, an NDA victory thereof?
I guess it's important in the scheme of things because we really don't have too many triggers out there at this point in time. If you look at the fundamentals by themselves, you're not seeing any signs of earnings upgrades. If anything, you will probably see earning downgrades in the current quarter and maybe in the next quarter too. But as of now, we are looking at about 14% growth for the March 16 quarter, followed by 18% for the March 17 quarter. So you still have some downside risk over there, I would think. As far as reforms are concerned, let's see, how the winter session of Parliament goes. But if the opposition continues, to oppose legislation, then maybe you won't see too much of progress on some of the legislative reforms, such as GST. So in that context, Bihar election becomes important. More from a sentiment perspective, it will probably mean that, people still have a lot of faith in the Modi government. It's an endorsement of the politics and the economic agenda being adopted by the India government. So in that way, it should give, some shot in the arm as far as the government is concerned to pursue more aggressive reforms going forward. Within the limitations of Indian democratic system, federal nature of governance, institutional inertia, all those things, you leave that aside, but at least, that would give some more confidence to the government to push ahead with reforms.
Sanjeev, always good chatting with you. Thanks much for taking the time out and joining us today.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.